According to supply managers in the 9 Mid-America states, how is the economy performing?
The Mid-American economy, that's the economy stretching from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south, it is booming. We're seeing some of the best numbers. In fact, the overall reading for the month of April was a record high. It was up to 73.9, and that's up from very strong readings for February, for March, I should say, 68.9. So this economy is moving along, constrained, if you can believe that, constrained by supply bottlenecks. 4 out of 10 of the supply managers reported that the bottlenecks and delays, they were experiencing significant bottlenecks and delays in deliveries. So that's slowing down the growth. Also, finding and hiring qualified workers, slowing down the growth. So we're seeing a very strong, robust regional economy, at least according to the manufacturing supply managers that we surveyed, and this, of course, is for the month of April. So very good numbers there. We're still off, say, 3 to 4% compared to pre-pandemic levels. In other words, the growth is very strong, still not back to pre-pandemic levels, but about 3 to 4%. We're moving in the right direction. We'll see those. And let me bring up a graph that shows you in comparison. In the blue there, you'll see the Creighton number. That's the Mid-American number. It's expanding briskly. The overall U.S. number will come out later on this morning. I expect it to be up as well. We're seeing some very strong numbers for the manufacturing sector, at least according to the supply managers.
What were the hiring trends?
Hiring was not as strong as the overall reading. In fact, the hiring number for the month of April was 57.2, and that's down from March's reading of 60s. Anything above 50s, growth positive, signaling expansions, but it was down for the month. And again, the reason it's down, what we're seeing is the declines. What we're seeing is finding and hiring those qualified workers. The stimulus package that was passed put through by the Biden administration is having some negative impacts on the overall hiring, simply because you're paying workers more to remain unemployed than to get a job. So we're going to continue to see that being an issue going forward. As most of the viewers know, there's a $300 add-on for those workers who remain unemployed. So not surprisingly, the unemployed remain strong in finding and hiring. Getting those workers to come out of unemployment into the workforce is becoming increasingly a bigger problem. We ask about the challenges, and again, employment still remains for the region we're still about 4.2% below pre-pandemic levels. That's overall the regional labor market. The U.S. market, labor market is down about 5.5% from pre-pandemic levels. We asked for the month what the biggest challenge going forward for the supply managers. 39% indicated supply bottlenecks, and that's a big issue. Getting those inputs in and outputs out, that's taking more and more time. And businesses, those connected to the manufacturing sector, seeing slower growth. So that's a big issue. 30% said rising input prices. Now that's a big surprise. The Federal Reserve won't like those numbers. We're seeing input prices growing at very strong paces. For example, housing prices year over year, 10 to 12% higher. That we're going to see those numbers continue. Inflation is rising. The ugly head of inflation is coming up, and it's a bit greater. I will say a bit greater, but increasingly a problem for the Federal Reserve. 22% identified finding and hiring and the shortage of workers, finding and hiring those workers that are needed for expansion that's going on. So it was a really big, strong number for the overall economy, but again, employment not as good. We'd like to see those. We'd like to see more and more workers into the labor force, out of unemployment into employment. So that's the issue.
What inflation trends are you noticing?
Inflation's at a record high. This is, of course, the producer price, or wholesale price index. It's up to 96.2. 96.2 when the range is 0 to 100. 96.2 is obviously in a very a strong reading, indicating significant inflationary pressures at the wholesale level. That's up from 94.0 from March. So that was an a significant uptick. I expect us to see that spill over into the consumer price index in the weeks and months ahead. So the Federal Reserve and businesses out there and consumers are dealing with higher and higher prices, and that's going to have some negative impacts on the overall economy.
What impact is trade having?
Those numbers were pretty good considering the global economy slowdown. So also, given the significant bottlenecks that we're experiencing, the overall export number was down to 58.8, and that's down from 63.9 in March. The import reading was down to 57.9, that's down from 64.0 in March. So both readings are still in a range that I would argue is pretty good. Again, given the significant bottlenecks we're experiencing. We're seeing it, for example, ports on the West Coast having some real issues in terms of getting those supplies off the ship into the transport sector, moving them out to the manufacturing sector. In fact, the delivery speed, the slowest we've recorded on record, delivery speed is 84.0. Now that number there, higher number, indicates slower deliveries, and that's up from March's record high of 81.3. So we're seeing some real issues in terms of supplies, and that's particularly the case for imports and exports.
What are indicators to watch?
As we've talked about in previous months, the number one indicator is keep an eye on the 10-year Treasury bond yield. That yield is up to 1.6%. That's up about 0.8% from last fall. So we're seeing more and more inflationary pressures. As the inflation ticks up, that yield ticks up. Also, as growth picks up, we'll see that yield begin to increase as well. That's one of the big issues, and that we can get that contemporaneously. Then the first-time claims for unemployment insurance, that number is looking better. We're now below 600,000 for the week. Now these come out every Thursday, and that's from the Department of Labor. That number is looking much better, and I think it'll continue to look better. But we are seeing again the incentives provided by the federal government are to remain unemployed. So that number, the first-time claims will be higher, the continuing claims will be higher. The employment report comes out on May the 7th from the U.S. Bureau of Labor Statistics. That number I think is going to be less than desirable. It's probably going to come in about 150 to 200,000. Last month's reading was 416,000. So that number simply will not be as strong as we'd like to see, simply because of workers are incentivized. They're not incentivized to take one of those jobs that are open. And finally, the Consumer Price Index on May the 12th, the Bureau of Labor Statistics releases that number. The last number was 0.6%. That's month over month. Of course, you multiply that by 12 and you got 7.2%. So that's a real issue. Keep an eye on that number going forward. And I expect it to continue to bounce higher. Inflationary pressures are going to remain a part of the scene for the next 3 to 6 months for sure.
What is the economic outlook?
Long-term interest rates are going to continue to rise. Mortgage rates, we'll see those move higher. Not as much as you might expect given what I've just reported on inflationary pressures. But long-term interest rates, even short-term interest rates are likely to go up at the end of the year. Now, it's not till the end of the year. The Federal Reserve is going to hold on interest rates, on short-term interest rates. Long-term interest rates are dictated by investors across the globe. Long-term investors are going to continue to support lower interest rates, but they'll lower than you would expect, I should say. They are going to continue to move upward, those mortgage rates. We're going to see a V-shaped recovery. I've talked about that in previous months. That is becoming strong growth. We're seeing GDP growth, but one would expect that when you have a stimulus programs. We put in about $6 trillion. The Biden administration is proposing even more spending, and of course that's going to result in a much more brisk, much stronger growth, and that's again going to result in higher inflationary pressures. I expect vacation traveling. Watch out for vacation traveling. We're going to see those numbers move upward. We're already seeing higher airfares. The airlines are increasing prices on tickets, and that's reflecting family travel. Business travel still not good. We're seeing conferences being canceled. We're seeing conferences being on Zoom or on remote. We're also seeing the regional economy is going to be growth is going to be somewhat lower than the U.S. number, and again, simply because of the issue of finding and hiring qualified workers. So that's our readings for the month of April. Pretty good, a very good report in some ways. Some troubling trends in terms of inflation, but all in all, it was a pretty good report. And until we meet again on the first business day of June, may your economic cup runneth over. And thank you for joining us.